All right, so just in a couple of days, we've gone from should we look for to see that we're actually getting an intermediate pullback, because we had a little bit of weakness going into the end of the week last week, to getting those signs yesterday, to now getting signs of more of a longer pullback. And so I'm going to explain what that means and how that changes expectations, and whether or not I feel like we're falling off a cliff here, and how significant this cliff dive was from the highs that we had 4 days ago. In fact, it's very, very rare, and I'm going to show you that in today's video, and what that means. Does that mean we can buy this dip? Does that mean that there's more selling to occur? How much further can we go down to the downside if that's the case? I'm going to break all that down in today's video, and take a look at our trade idea, where, in the volatile times like this, you want your reward to risk ratio to really protect you. Limit your risk when you're wrong and maximize your reward when you're right. And we're going to talk about how to do that today as well. So let's go ahead and get started. Today is Tuesday, February the 25th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see the short-term sentiment is extremely oversold now. We are below the 5th percentile on the momentum line. Near-term line, again, is more oversold than it was over here. And that was the last intermediate pullback we had. It really wasn't much of one. But that was about as much of an intermediate pullback as almost we had here with an intermediate bounce, because we didn't really have a pullback there either. But we did break the 38% retracement. We are into the retracement zone here between the 38 and 50% levels. In fact, we are hitting the 50% retracement fan and the retracement level here, where they cross over each other. It's not too common that we hit those at the same time, because we really have to fall pretty sharply for that to happen. But and we have to be really, really close to the all-time high. Like, the fact that we've fallen 7% here from this all-time high that we had just 4 days ago is pretty crazy. Like, in fact, if you were to kind of go to a rate of change here, and you look at here, let's take a look at the rate of change. Sorry, we'll go 5 days on this rate of change. Actually 4 days, because it's from the close of that 5th day. So we'll go 4 and 4. So you can see 7.6% is our decline that we have right now in the last 4 days. And if you look at other times, that was not from an all-time high. That was close from an all-time high, but you notice we didn't get down to this level. This was not from an all-time high. This move over here, because the all-time high was over there, and we had taken some time. So this fact that we are, and if I were to go like all the way out, say 20 years, to look at other instances where we've fallen this far in this amount of time. This was not from there's that August 15th. The last time we had 2-3% down days in a row. That was not from an all-time high. Over here, 4 days was not from an all-time high. That occurred over here in May of 11. Actually, that wasn't the all-time high either, because this was still coming up off the low point. And you can see here, decline again, not from an all-time high. Because the all-time high is way up here, right? The all-time high, if I zoom out to this 11 period, the all-time high is way over here. So none of these occurred even close to the all-time high, much less a more recent 52-week high. So this is not only coming down from a 52-week high, but also coming down from an all-time high. In that short amount of time, to be down that quickly is extreme, to say the least. Right, to say the least. So we'll talk more about that here in a minute. But you can see the short-term sentiment. The intermediate line is going to cross below 50 tomorrow. Even if we bounce back up, most likely it's going to cross below 50 tomorrow. In fact, I'm going to venture to guess now we're going to get a market sentiment. Whereas a normal intermediate pullback might last a few weeks. Again, if I were to zoom out here so you can kind of see the difference between market sentiment pullbacks and intermediate pullbacks. See, here's a market sentiment pullback. Here's a market sentiment pullback where the orange line falls below 50. Here's the intermediate pullback. Here's an intermediate pullback. Here's an intermediate pullback. Here's another one. Here's a brief one. These are all intermediate pullbacks. So you can see the difference between those and the market sentiment pullback. So the intermediate pullback might take weeks, maybe a month, month and a half. The market sentiment pullbacks might take 3 months, 2 to 3 months. So And I think we are now to the stage where we're probably going to get a market sentiment pullback because of how extreme this selling has been the last couple of days. Fortunately, there's plenty of support down here, so it's not like we're falling off a cliff, even though we kind of did fall off a cliff here, 7% off of a really, really high cliff. And that was really the issue. The problem was, and we've been talking about this, is if I were to come over here to February the 19th, so let's go back 1 year time frame to February the 19th. So we'll go back over here to February the 20th. February the 20th of 19. So we got a 1 year pattern. Again, you can see how far away, you can see how these volume nodes compare to the actual volume nodes. I mean, those are some pretty big volume nodes, and these are pretty small. Relatively big, but in other words, the chunk, this big chunk represents 30% of this year's volume. 70% of this year's volume is way down here, and that's the floor. So the price, walks a tightrope that far off the ground, right? That far off the ground, and that sets you up. We should have built out, we should have pulled back more in this area and built that more and some volume more in that area. That would have held, that would have allowed this 318 level to be more of a support had there been more volume built up there. But there wasn't. Again, intermediate pullbacks take a few weeks to maybe a month and a half, and there wasn't. We kept going up. We had another chance for an intermediate pullback over here, and it didn't happen. We kept going up, and so we didn't get enough volatility in these areas to build up enough of a floor to hold as a strong support level in these Fibonacci areas, and so this happens. And that's just the nature of the beast. And that's why we talked about, as we got more and more mature in the intermediate run, 4+ months, because it started mid-October and we got all the way through mid-February and beyond. So the longer we go, the more likely, the further the tightrope gets off the ground, the farther we can fall to get to the ground. But the nice thing is, again, at that 62% retracement level, that's where the value area is. That's where the ground is. So and there's actually still some room to go until we get to that point now. So whether we diverge, I'm going to venture to guess we probably diverge into that low point. But here, I'll show that in just a second. Let's go back to the market forecast and let's look at the other chart. So there's the Russell 2000, and you can see it looks worse. Its intermediate line is below 50. It had that really bearish intermediate high point there that we had noted already, and it's now through to getting to the bottom of the Fibonacci retracement zone. You look at the NASDAQ composite, and that's been the big driver of risk appetite. It's down to the 38% level, getting you a red line. And then finally, the Dow Jones Industrial Average is through the Fibonacci retracement zone, all the way down to 27,000, and has dark pink shading and a red line way below. So, I mean, this is extreme. These extreme levels typically, and you can see, too, if I were to go to diamonds on the Bollinger Bands, where the value area is there, and you can see we went back into the value area and now holding this first little volume node for a support level as of right now. We'll see if that ends up holding. Again, if I were to look from mid-October, there's that mid-October or that early October low point that we bounced off of, and then we came up here to these highs. So there's your Fibonacci retracement zone, and then if I were to throw on that 78% level, which, once we break through that, then you're looking at a reversal, right? A bearish reversal, bounce and then a reversal through. There's some pretty good volume between now and there that can keep you from and a real significant layer of volume down below that level. So most likely we're not going to head into a recession here and a big long-term reversal. But there is still some downside potential, especially in the S&P 500, where, like I said, we might bounce in the short term, but there's a really good chance that we form and these big moves like this, we tend to get bullish divergences where we get lower lows with the oscillators giving us higher lows, especially something like the near-term line. So watch for the near-term line. Watch for a move down at least to the bottom of this retracement zone towards that value area, like the Dow has, before we bounce back up. And that we might bounce back up really quickly tomorrow and Thursday, but don't, as I mentioned today in my class, my options trading class, directional option strategies, if we bounce, when we have market sentiment runs or even intermediate pullbacks, we don't go down every day. That whole few weeks, we don't go down every day. We have some periods of upward moves off the most extreme lows. Don't get caught up in those bounces, thinking that, okay, now here we go, we are back. In fact, look for it to hit that fan for some resistance area and then roll over and continue this, continue the intermediate pullback and what I believe eventually will be a market sentiment pullback now because of how extreme this move was. All right, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below our video. That will notify you when these videos are posted on YouTube. Click the thumbs up icon down below the video. That tells me two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. Quick way to give us feedback there. Comment down below on what you're getting out of the video today. What did you like about it? What did you get out of it? Let us know and let anybody who comes. Because as you know, when you go to YouTube and you watch videos, sometimes you look at the comments to see what people are saying about it. So let other people know what you're getting out of the video as well. Join our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching this on our website here, you can see there's a lot of other things to check out. Check out our Market Outlook live videos. I didn't do one today like normal because I am filling in for Brandon. He's out under the weather today. But I will do another one tomorrow, and we'll review some trades. In fact, I did close out some trades. Our premium subscribers get our trade alerts, and so you have seen those. But I have closed some of our old Market Outlook trades, and I talked about why and what we were looking for. Some of them actually made some money. Some of our more recent ones have made some money where it's time to get out of those. So I talked about that yesterday, and today I posted some Telegram alerts for those. So make sure that you are signed up for those if you're a premium subscriber, and check that out if you're not. Something you might be interested in. We also invite you to engage with us on social media. Click this little heart. It opens up this page. You can like today's Market Outlook tweet. Click the thumbs up. You can do the same, like today's Market Outlook Facebook post. Again, that benefits you because it makes sure that they promote our content to the top of your timeline. It benefits us because it makes sure that they promote our content to the top of everybody's timelines that follows us because it's engaging and it has likes and retweets and things like that. So also you can share this with other people too through Facebook and LinkedIn and Twitter with these links down below. All right, back to the charts. If you look at the 10-year, the weekly crossover chart, you can see we're really close. That 50% retracement level is where the 200-day moving average is, and that's around 3,100. We came really close to touching that today, and don't be surprised if we don't. And you know, a lot of times we might flirt with going below the 200-day moving average, like we did in January 2018, and that really significant selling week in February that started February 5th. So we can definitely kind of flirt with that 62% level and end up with a candle that looks very much like that one. Wouldn't be surprised at all. And that was another time that we had the PPO this strong before. If you look at the 3 green arrow charts for SPY, obviously we have 3 red arrows. Look at that significant volumes, 217 million. Big trading range again today, 13 points. Very similar to what we saw yesterday. From a 2-line versions, we are, and this I tweeted this out, so make sure you follow me on Twitter. We are way below that 30-day moving average. In fact, if you look at this chart here, and let me get up, I'm going to show you how far on a percentage basis we are below the 30-day moving average. Hit OK on this. I'm going to change this to a daily chart. So let's change this to days. All right, so we are now over 5%, 5.33% below the daily. These are still the 50 and 200-day moving averages, but we are pretty significantly below the 30-day moving averages. You can see in the past that's about as low as we've gotten, and before we had some really short-term bounces. Now, just short-term, you can see that started the market sentiment rally decline. That started the market sentiment decline. So, it's not like we're going to bounce back up to that 3.5% mark or 2.5% mark, wherever I've got that now. Don't expect that we'll bounce right back up there. We did over here, but that was the end, right? That was when we got 10% below, and that was a death cross environment. Usually when you get down to these really significant levels, they can be really significant death cross environments, like you saw over here when we also got almost 10% below. So, very good chance that the market sentiment pulls back, which means a couple of months of dark red, dark pink shading. When I say market sentiment pullbacks, what I'm talking about is And here we were just a few days ago looking for signs of an intermediate pullback. Here we are now looking at a market sentiment pullback. But if you look at these, when you have market sentiment pullbacks, you have periods of time where you have dark pink shading and red lines. It's not all dark pink. There's lots of green. There's even some dark green in there. But you can see these are your market sentiment pullbacks that get the dark pink shading and the red lines for an extended period of time. Here's your intermediate pullbacks where they tend to be shorter. And so you notice we didn't go down every day in these, right? There was periods of downs and bounces off to extreme lows and then retest of lows. And that's kind of what I expect here. I expect that we'll have a couple of months of dark pink shading and red lines interspersed with light green shading and yellow lines, red lines and dark pink shading. So it's not going to be every day. There's going to be periods where we really bounce sharply, but I don't think that we'll really bounce sharply off this first low point to a new intermediate run. We'll bounce sharply and then we'll retest these lows and maybe go even lower, at least to that 62% retracement level, if not down to where that red line is this old intermediate high point here. All right, so now let's take a look at the intraday move, and obviously we're in the path of least resistance now to the downside. Very, very little volume, but also keep in mind the reason why we bounce up so much in the short term is there's very little volume, not only where we're at, but also above us. So it's really easy to fill that in, to the upside. And there's obviously, if and when we do, there's a significant resistance there at 325. So most likely it's going to be hard to get up again because that's going to be sitting on top of you like a big 100-pound weight, right? So, but you can see why it's very easy to bounce in the short term off these extreme moves. There's very, very little volume above us. So that's why I say expect a bounce. The other thing too, the reason why I expect a market sentiment pullback is the volatility really jumped up today. So it continued all the way up to 30, pulled back a little at the end of the day, but we still ended up above the 115% mark. That's kind of the threshold that if you close a day above 115%, then that's enough of an extreme move to the downside where we get the market sentiment declines. You can see if I go back again, those 3 years to the last market sentiment declines we had was right here. And you can see we finished at 150, almost 116%, and then over here we finished at 126%. And that was a real significant decline in January of 18. So that's a pretty significant decline. The one nice thing about this, and here's the nice thing about, if you look at trend, when you look at those levels from back, the last time we had market sentiment declines, look how low the 10-day moving average was for the trend. So we had, it was a very, very, that pretty much tells you how frothy the market was. It was very frothy, not only in January of 18, but also in October when we had that next market sentiment decline. We had a very, very frothy market. That means we had a lot of advancing volume versus declining volume on this advancers, on both of these. Here, not so much, right? We had this nice move to the upside, and we never did get frothy. So I don't expect a significant, I expect a market sentiment pullback, but not even to this degree. It's going to be, we're going to get a nice little low point set up in here. It's going to take a while for us to hammer out a low, but that's okay. We'll build that foundation, build that volume node, and then bounce off a stronger support level that can hold us up better. We won't be so high off the ground, right? It'll bring that value area up higher, and it'll provide us a better opportunity to bounce than what we've had for a long time, pretty much all the way since this low point we bounced off of in October. One more quick thing, again, looking at today's volume and trading range. Volume over 217 million, almost 218 million. The trading range was 13 points. So you look at the ATR, the price level, and look how high up we are. Again, go back to these last market sentiment peaks, and the average ATR, the ATR to price, got up above the 1.5% marks on these moves. We're headed that way here again. Because of these big strong moves, we're going to easily get up close to 2% because this is lagging, right? It's an average. ATR is an average, so we're really going to get up here high. And again, it's going to take a while for these lines to come back down. And again, we're at 200 million, so that average is going to bump up higher too as we have more volume around this level. And that's okay because, again, that's going to build. The more volume we get in this area, the more we'll build up this volume node and bring the value area up, build up this volume node. We'll be able to break out and have a much solid base underneath us than what we've had because we were so far up off that value area. Look at the Ichimoku cloud really quick too, and obviously we don't have the bullish trend anymore. In fact, we're just like that down to a moderately strong bearish trend, but look how we're below the cloud. So that doesn't mean necessarily that we're going to move to the downside pretty sharply, but it kind of give you an idea. There's our last volume node when we were this far up off the cloud. That's that market sentiment pullback. And then here's a market sentiment pullback where we got pretty significantly below. It started a little bit below, and then the cloud kept going up, and that's this doesn't look like the cloud's going to keep going up too much longer here. But it kind of gives you an idea of where you can see how we filled in the cloud as we bounced. Over here we kind of used it as a resistance level. I kind of expect that we'll probably fill in this cloud and use it kind of as a resistance on the way back up before we get some pink shading in, and then that sets us up for the breaking through that will set us up for the new long-term run there into the end of the year. So to summarize, we are now probably going to have more of an extended pullback. It might take a couple of months, but we're not looking at a big, deep recession. It was a very extreme move. It does. There will be some ups and downs during this next couple of months, and the first up could be as quickly as like the next couple of days, and it could be a nice, good bounce to the upside. Don't get suckered into thinking, okay, let's buy this dip and here we go. Because I don't think necessarily you can buy this dip yet. I think you're going to have some ups and some downs. If you weren't able to close out some of your bullish trades, you'll get an opportunity on this next bounce to close them out at better levels instead of chasing to the downside here. But even that's, who knows, right? Headlines can push us down even lower. That's not a guarantee either. That's just an expectation. But needless to say, we were very extended to the upside. We weren't too frothy, so we're not. That's why I'm not expecting a recession or big, huge bear market. We weren't too frothy. Yields are extremely low, as you'll see in a second. So it's not like we were teetering on the precipice of recession. So I don't expect a big bear market out of this. But because we didn't have enough of a pullback over the last couple of months. We went so long without one. The longer you inhale, the bigger the exhale is going to be. And once you have that big exhale, big long exhale, because you were inhaling for so long, then you're going to have big inhales and exhales pretty frequently until you settle things down and get going again. That's kind of what I expect over the next couple of months. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either you're a lot more bearish than I am, or you're expecting a V bottom, that we're going to bounce right off of this, and here we go back to the upside. You're ready to buy this BTFD and get going here. So just let me know what indicators or charts you're looking at down below that would suggest that. All right, now let's talk about what's driving the price action. Of course, we all know what's driving the price action. In fact, if I were to go back the last 4 days, those same 4 days that we're down, so 1, 2, 3, 4, so the open of the 20th, and just look at, since that 7% decline on the S&P 500, look at everything else that's down too. Crude oil's down 7%, 6.5%. International stocks are down, small caps. It's a broad risk off move. To the upside, you have gold. It's actually pulling back the last couple of days, but long-term bonds are holding up near their highs, and you'll see that here in a second with yields really declining sharply. But look at the dollar. The dollar, which had been so bullish, it's also pulled back. Real estate has pulled down in the last couple of days. High-yield bonds have pulled down, still outpacing stocks, but not anywhere close to what long-term bonds are. So obvious risk-off pattern here. Some charts that kind of stand out. When you look at the 10-year note, look at that. Again, another cluster, another couple of clusters here. If you look at the weekly chart for yields, we're getting a weekly cluster on that chart. And then if you look at the monthly chart, look at the monthly cluster. So this is the second kind of cluster in a row. I've mentioned before this concept of a divergence, and we actually got the last divergence that we had on the weekly chart. If you come over here to 2000 and 2011 and 2012 was a lot that I've kind of mentioned this divergence, that we're getting something very similar going on here. I've been talking about that, during this little rally and this little rollover that we had. This watch for divergence because of how low the PPO got. It's really hard to bottom off of really low levels. We usually diverge off the really extreme low levels on this long-term chart, mind you. So if I were to go back here on the market forecast and go back to that same monthly chart, there's that 2011, there's that divergence. So we got clusters kind of one after another, one on the first low and then two on this one. We're doing it again. We got one on the first low and two on the second. We ended up getting a third low, which ended up being a kind of an inverse, or excuse me, an inverse head and shoulders pattern here, and we rallied higher. So we could very well get something like that again, but we are in that second low point, and we clustered here. It took a few months, but after a couple more months of figuring out this low point, then we started to rally, and yields had a really good run, and so did stocks during that time. Again, another reason why I don't expect a huge recession, because yields are already historically low. If I had to ask myself, going into a sell-off, would I rather have a sell-off with yields really high, or this is 2007, right? Relatively high. I mean, look at the yields were over 5.25. We're at 5.25% when we were rolling into that bear market. We're not at 5. We're at 1.25. We're going to be flirting with 1.25%. That's not like when we were coming into this level. The market was worried about a double dip recession, but again, it's kind of hard to have a double dip recession when yields are already significantly low. In fact, because of that, yields being really low is actually very stimulative. From a market standpoint, as high yields, when short-term yields are really bounced up higher, that tends to be very restrictive and what leads to a bear market and recession. We don't have that right now. So keep that in mind when we hear about people talking about recessions. Is we haven't raised rates so high that we have such high short-term yields that it's restrictive. We are very similar to 2012. Again, the market thought the world was going to end. The Eurozone was going to break up. The world was going to end at that point. We had a credit downgrade. Europe was going to end. I mean, the world was going to end. And we didn't get a recession. We rallied, and yields rallied off of that. And I fully expect something similar pattern to develop out of this too. Let's take a quick look at how crude oil is doing. So let me come over here to the market forecast. Crude oil, you can see it's kind of double bottoming too. It had that bearish pattern. We talked about that being a very bearish pattern. Well, it since has rolled over and we're back down below this. So it's kind of a fake out move, and we're back below this Fibonacci retracement. But again, you notice it's not really dropping sharply because it already had dropped sharply. It was already telling us something that we hadn't seen yet, right, on the S&P. So we have already had this level of risk off that we're seeing in equities. We've already had that. And remember, it's falling below the 78% is when we have this bearish move and we retrace, we bounce off of this and we move back to the upside. Well, if we're going to move back to the downside, then breaking that level, 47.5, would be significant. I fully expect a kind of a divergent low point to develop around that point by the time all is said and done. In fact, if you look at the CCI and the RSI for crude oil, you can see again we've already had significant lows, and I fully expect a lower low to develop with these higher lows on these oscillators. If I look at the MACD and stochastics for these, something very similar, and obviously something very similar to happen here too. So still some more weakness, still some ups and downs, right? Volatility, but I expect some more weakness in this area, and then a bullish divergent low point to form. And then, a month or a couple of months of choppiness before we really get going on the new intermediate run, kickstarting a new long-term market sentiment run. Looking at the sector rotation, look at all the dark pink shading we're getting. Red lines, dark pink shading in financials and industrials and communication services and energy. I mean, it's all across the board. The only thing really that we're not getting are these really bullish patterns on utilities and real estate. But again, not the pattern I would bounce. But I fully expect them to turn into dark pink red lines too, just lagging, right? Because they tend to hold up better. As you can see over here, they hold up better during the rallies. But you can see even staples is already light pink and red. So they'll still decline, just not to the same extent. But these cyclical areas are really declining, and then they'll turn into it. And I showed you before, the same thing in the foreign. When you look at the foreign markets, the major foreign markets here, very same thing. We had already been seeing lots of dark pink and red lines, and you expect that Canada and the US will start showing it too, and they're showing some clusters because of how oversold they are. So keep in mind, there's some extreme moves to the downside. You know, we're going to have a more of an extended pullback. These are already market sentiment pullbacks in a lot of these areas. Japan, UK, Brazil. I mean, if you look at some of those, some of their market forecast charts, here's Japan. Its market sentiment is already pulled back below 50. Brazil is getting close. Germany, Germany is going to work its way down there. The UK is getting close. So they're already in market sentiment pullbacks, and a lot of these others will get there too. Energy is in a market sentiment pullback. There's materials is getting close to one. Financials is most likely going to bring that orange line down below 50. Then there's industrials. So these sectors are giving us, and all these foreign markets are giving us the declines that we'll probably get in the S&P too. Again, not every day is going to be a down day in the next couple of months. There's going to be some nice bounces that are going to sucker you in. Sucker rallies are going to sucker you into thinking, here we go, back to the upside. But that's not, they're going to be good rallies to be able to sell and be able to maintain some bearishness and sell that volatility to be able to maintain, you know, as we figure out this low point and put some volume down here. So as we look for some downside, some stocks that have the bearish deltas that we can add in case of any kind of downward moves, even if short-term bounces, you have to kind of pick and choose, because otherwise you're going to be chasing big moves. A stock like Walmart, you can see, you know, it's kind of formed a lower high point. We're rolling over. We're in the lower half of the bandwidth. Again, we're breaking below a big significant volume node, and there's not very much volume at all below us. So there's one little area of support right here, but other than that, until you get down to this 102 area, very, very little volume because we moved up here so fast and gapped up here. That's not a whole lot of downside potential. You look at its market forecast chart, and you can see it's just barely below its 30-day moving average. The market's way below. It's barely below its 30-day moving average. It has dark pink shading, or it has a red line that's about to have dark pink shading again. When you look at its 50, 250, and 200-day moving averages, you can kind of see how we got a little bit of an head and shoulders developing with falling momentum. So you can see what the downside potential is on a stock like this. Looking at the 3 green arrow charts, and you say, okay, let me look at the, you know, we had kind of crossed up above here, and then a lot of times those fake outs can be pretty bearish, similar to something like that. They can be pretty bearish, and we're closing below some of these lows. MACD is about to cross back below 0 again, stochastics crossing below 50 again into the lower half of the chart. So, you know, if we bounce up, I want to be able to have a strategy where I can risk very little, but if it continues to go down, I want some opportunity, and that's where a trade like this, a long put vertical spread, where I buy that 110 put here, buying the 110 put for $2.13, selling, covering some of the costs of that with the 105 put. That gives me an $83 put. If I position size around 50%, because it's a very directional trade to the downside. So if we do bounce up, I would like to be able to keep my loss. Worst case scenario, half of my normal position, but in the best case scenario, even half of that. But then you can see I've got a $2,500 potential reward if we do keep falling down. So if we bounce up, very small risk, $250 ideally. But if we go down, to $2,500 reward. So about a 10-to-1 reward to risk ratio. That's the type of strategy we want to be looking for right now. We want to have things, because when the volatility is high, you can get big moves both up and down. We want to be able to limit our risk when the big moves are against us and maximize our reward when the big moves are for us. And that's what we do in a situation like this for Walmart. All right, so that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link right there. It's popping out in the top right corner of your screen. And that takes you to our Market Outlook forums. Post any new thread there with any questions or comments you have about what's going on today and what we talked about in the video. And let's keep this conversation going in our Market Scholars community before our next video that we have overnight. So again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and join our website at marketscholars.com for free, as I showed you earlier, as well as our Market Outlook Facebook group. Have a great rest of your Tuesday evening, everybody, and we'll see you all next time.